you can't be the same person tomorrow that you were yesterday. And part of the problem with a sector-focused fund is good for now, but it becomes a straitjacket. And you want to avoid wearing a straitjacket to work every day. So my advice to people, if you're trying to raise a fund, you need to be good at something and have a track record and credibility, but that something needs to be broad enough that it can extend into the next new thing.
Welcome, everybody. I'm Mark Peter Davis, Managing Partner of Interplay Ventures. On this podcast, I interview innovators and venture capitalists about their strategies, industries, and decisions. Today, we have Ian Sigalow. Ian is the co-founder of Greycroft, one of the biggest VC firms in the world. They have 50 employees, which by VC standards is absolutely gigantic. They manage several $billion and have had tremendous success over the last decade. We have a great and candid conversation about the world of venture capital and what Ian thinks is happening within it. We talk about the spread of innovation around the world, managing funds across the company lifecycle, and what it takes to make a great founder. I hope you enjoy the conversation. This episode is brought to you by Spark Digital. Spark Digital is a full-service provider of technology consulting, software design, and development services. They work with companies in the communications, media, and technology industries. If you're interested in learning more, visit sparkdigital.com. Welcome, Ian.
Thank you for having me.
Thanks for being here. So before we get into this, I'm actually going to introduce you. And historically, I've had people introduce themselves, but I think that gives too much airtime to things that are easy for you.
Oh, you're right. You're right.
It's going to be too easy. So first, before we get into that, how long have we known each other? So people have a little context here.
Oh, God, you're giving me a pop quiz. So what you were Columbia Business School 08,
you got
right?
it. You got it.
And I was 06. So I'm guessing we met in 2007.
Okay, yeah. So it's like we're 15-ish years in. I've been watching you through your career, and I think I can probably give it a pretty good summary. I'm probably going to miss a bunch of stuff, so I'll let you fill it in at the end. But for the folks who are listening, Ian, he wouldn't say this, is wildly smart, and that'll become self-evident as soon as he starts speaking. He did his undergrad at MIT, his MBA at Columbia. He's been a VC for longer than most. He essentially started right out of college. So unusually for someone our age, he's got 20 years of experience. I think we're both rounding up on 42, and I'm only 15 years in the game. So he's probably one of the veterans for our age group. Ian joined Greycroft's founding team as an associate in 2006 under the famous investor Alan Patricof. I believe Alan has since retired. And now Ian is one of the two remaining co-founders and managing partners who run the firm. They manage $1.5 billion, and our bracket, they've backed a number of household names, unicorns that everyone knows. Some recently popular ones are Bumble, Acorns, Goop, Plated, Thrive Markets, and more. There are about 50 people on the team, which if you're not familiar with venture is absolutely enormous. Large venture firms are 10-ish people. And it's safe to say Greycroft in and of itself is one of the unicorns out of New York in the venture business. It's one of the companies that has kind of scaled very quickly and become a household name in our industry. So now that I have stolen all of your material, Ian, let's have a real conversation.
Let's do it.
Did I miss anything?
I was hoping you would work in the word synergistic, but you didn't.
It wasn't corporate-y enough for you? So let's jump in. I want to start off with getting into a bit about Greycroft. I know you were just out for a run, sweating off a board meeting you just had with your LPAC. For those who don't know, it's essentially your board of investors if you're a VC. How is the company doing?
God, you go right into the heart of question.
I'm going to put you on the heat today.
Yeah. So some historic information to level set where things are. So, we manage just over $2 billion of LP commitments across 6 early stage funds and 3 growth funds. The The first early stage fund, we don't have an LPAC for. It was just friends and family. So we'll carve out that $75 million pool. We have deployed, I don't even know, probably $1.5 billion, maybe $1.6 billion. So call it about 500 million of dry powder, maybe more than that, actually. Maybe
that's not always the way the math works, right? I just want to make sure for people listening, maybe aren't as familiar with the VC game. When a VC typically says they manage a certain amount of assets, that's inclusive of all of the funds that I believe are still active. So those funds might be just maturing, but not be actively being invested. They might have invested those 5 years ago. So when you throw out the 2 billion number, how big is the current fund you're deploying?
So the most recent early stage fund is 315, and the most recent growth fund is 373. So
that's awesome.
We've got,
those are huge capital pools, especially by East Coast standards.
Yeah, so in total, and we're investing them at the same time, different teams on each, but it's just shy of $700 million of dry powder that we raised last year. And we're investing $300 million a year right now. We also have a SPAC, which I didn't include in the number, but there's a $285 million SPAC too, which we talk about that later. So that's kind of the I guess the background on what we've got, the context. And we looked at our unrealized NAV. So this is we've sold and distributed hundreds of millions of dollars. But I would guess of the cost basis remaining, there's probably $1 billion of cost basis, and it was marked at the end of last year to something like 2.3. Keep in mind, a lot of this is young money, so certain things have only been in the portfolio for a year. And first quarter year to date, so we're 8 weeks in to 2021. We're up $700 million
that's incredible
on our unrealized NAV. We don't mark this way.
Yeah.
But there have just been, and I think in the history of the firm, we've had somewhere between 6 and 8 companies that we seeded or did early rounds in, A rounds that have gone on to be valued at over $1 billion. Essentially like one a year, virtually every year for the past 6 or 7 years. We've had 6 new companies print valuations over $1 billion in the past 8 weeks. So it's kind of gone vertical.
Yeah, and is this Greycroft or is this the market at the moment, or both? Because obviously you guys are great investors.
I asked my LPs. I said, "Are you seeing this everywhere?" And it was kind of a muted answer, which was like kind of. I think that there are certain funds that are enjoying a very good 2021 because we're in the right sectors, and it's risk on and fintech and consumer internet and certain places in digital health, and we happen to have big insurance portfolio and other things that have just gone wild. I think the other interesting note is that not a single one of those unicorn companies this year was based in San Francisco. Not one.
Very interesting.
And this is the problem, I think, with investing historically, like pre-COVID, investing outside of San Francisco. When you're a public company, the public markets don't care where you're headquartered, right? You could be Chewy based in Miami, and you're going to trade at the same multiple headquartered in Miami that you would trade anywhere, maybe even at a premium because corporate taxes are lower. So like wherever it is, the public markets are totally rational. The private markets are totally irrational. And up until last year, there was 100% premium for being based in San Francisco. And it might have been even more than that. And it was, it is skewed. So companies like a Notion that go straight from seed to $800 million pre-Series A, along the way if they were in New York, would have raised 4 financing rounds, 100, 200, 550. It would have taken 3 times longer, and they would have been diluted by 50%. I mean, just look at the difference between Datadog and all of the early VCs and rounds that company had along the way compared to a company in the Valley that had a similar user profile and trajectory and revenue, but the valuation ramped so fast. And early stage investors in San Francisco really enjoyed the benefit of this. And I don't think they even because it's like the frog in the pot. You don't realize that this is happening when it's happening, but it absolutely benefits your IRR and your ownership because you're not diluted as much when companies rocket up in valuation, because the subsequent financings end up happening and like, oh, well, we raised $200 million. We sold 10% of the company in a Series B. Like, well,
right.
that would never happen in a New York company during that period. And I think since COVID, capital has become unlocked. And, the multiples that were historically conveyed to companies in San Francisco alone, there are many other companies in many other geographies that are now seeing similar multiples applied to their businesses. And I'm kind of testing this theory out as I'm telling you this, but I think that's part of what is happening, which is helping East Coast VCs and Midwest VCs like Drive Capital and others, that we're all seeing our portfolios perform in a way that it would have been much harder to do if people had to get on an airplane and sit down face to face and fly to Columbus, Ohio to look at, whatever company in person.
It's interesting you say that. We're obviously a smaller operation than you guys, but we have seen the same bump in Q1 where companies have popped. We've got a couple of companies that are now in unicorn territory that weren't there, 3-6 months ago. But I don't think I had correlated it as much with the breakdown of the geographical barrier. I had my head around that just the market's in a little bit of a frenzy. And capital is moving aggressively. The government's printing money, all the things that are, stimulants and driving the capital markets. Do you think, I guess one of the questions for this is, do you think there's a material change in the dynamics people are seeing in Valley deals? Because if they've stayed flat and everyone else has gone up, then it is a geographical shift.
I don't know. I can tell you, and I don't have empirical evidence. It's not as if I've pulled down top whatever deals by geography across the U.S.
We'll get your team on it.
Yeah. But I do know from I would have conversations with CEO. One of my favorite stories is with Bill Smith, who was the founder and CEO of Shipt. And we led the Series A. And Bill said, Ian, my company's worth $100 million. And I said, I'm giving you a term sheet at 45 pre. He said, my company's worth $100 million. Like, I'm going to go to the Valley. I'm like, good. Take my term sheet, go to the Valley. Tell VCs you want $100 million per. You can even tell them you got a term sheet. You can do what you need. But you have to tell them there are no direct flights between Birmingham, Alabama, and San Francisco. And see and this was 2016. And right. See how many VCs raised their hand to fund you. He was worth 100 pre. Like there was no doubt in my mind that company was worth.
That was just simply the inconvenience of going to the board meeting, or was it concern that the infrastructure in Birmingham wasn't sufficient to bring talent and capital and support the company?
All of it, but every company's remote now.
Right.
So that's the other thing. How do you? And by the way, I mean Valley's the air quote, the Valley's a lock on talent when no one lives there anymore. Like, right. I don't know, my engineer used to live in San Francisco, but they just bought a home in Nevada because they're tired of paying taxes in San Francisco and having organized crime knock down their door and whatever. Like, okay, well, so be it. Like, people are free to move wherever they want.
I saw an interesting little video montage put up at the Wall Street Journal, and it was making the argument through some research studies that by not having people in geographic proximity, you actually lose a degree of innovation. They had done some studies. When I saw it, I was like, okay, there's probably some merit to the work they've done. My question now, though, is, are we going to be in a world where there is density in 7 cities? Right now, there's only been density in 2 or 3 cities up till this point. I don't know what the tipping point is for innovation to really harvest, manifest. But maybe we'll have enough of that in Miami. We have it in New York. Maybe Boston will pop back up the way it used to be, right? Chicago will hit, right? So that's what I'm looking at this and wondering, are we going to see a slowdown in innovation, which is what they're suggesting, or are we just going to see more innovation in more places?
I don't know that either of those answers is right.
What do you think might be happening?
Well, I think that we're seeing an acceleration in innovation for a lot of reasons. One of which is just the macro environment and people out of work and they've got more time. And then there's also just like I'm working for a company I don't love. And I didn't realize how much I didn't love it until I spent all of this time at home. And I'm now not connected to my coworkers and I'm not getting my massages and free lunch every day at Google. So maybe I'll work on a side project because no one's looking over my shoulder anymore. And that's happening everywhere. So I think innovation is accelerating. Second point, there are only a handful of cities in America, I mean, here in the world, that produce all of the software that the world runs on. It's really kind of an unbelievable thing when you step back and say, well, where is all the companies in Europe and the United States and Latin America and where they run on Microsoft or Google. They have Apple phones or Android phones. Like you just look across this, where their software is hosted on one of three clouds. Maybe they're using Akamai for their CDN, but it's like how many cities in the world produce massively scalable software companies? Which is why all the wealth in the whole world is concentrating in the United States in a couple places. And I'm not so sure that is going to change. Because I think that people are moving for various reasons during COVID. I think that the cities that were very popular in 2019 will be popular again. It may take a couple years, but my friends that are moving are also thinking about it as like, we'll do it for a year or two, but we're going to come back. I think a lot of people are also just lonely. So, you move and you're like, well, I've been living in New Hampshire on a whatever. And like, this is okay for now. I need space, but I can't wait to get back and see people again. And the loneliness drives a lot of behavior.
So let me take this a different direction for a second. You're managing a ton of capital at this point. The firm's large. Well, how big was your first fund back in 2006?
It was $75 million.
$75 million, which is a pretty good sized fund for a first fund, but nothing of the caliber where you're playing now. Why do you think Greycroft was so successful? If you could look back and pull some wisdom for what changed. There's a lot of VCs in the market, a lot of people trying to learn.
First off, I don't know that we were so successful. And we were like a 3x fund.
I think that's generally top decile by VC metrics.
Yeah, I wasn't happy with that. Like there's so much more opportunity, the things that we missed. So one is, we wanted to fund really only internet companies in 2006. And we didn't get caught up in the first wave of nano and clean tech. And
that was very popular.
We weren't distracted by some of those things, which, sector rotation is everything in venture capital. You're in the wrong markets, forget about it. You lose all your money. So we were in the right markets, both, from
but the internet's kind of been the right market. No,
it wasn't the right market from 2001 to 2006. It wasn't the right market.
That's true. That's true. That was the trough.
Ripped off.
Yeah.
So it was the right market then. What else? I mean, we launched the iPhone launched 12 months later. And we didn't really start funding companies based upon a mobile thesis until Fund 2, which was 2010. Although it was pretty evident by 2000, I don't know, let's say the iPhone launched in Q1 of 2007. By Q2 of 2007, it was pretty evident that this was a thing. And some tailwinds from the iPhone certainly helped our broader portfolio grow faster.
But you're telling a story that it was right place, right time. There's nothing more to it?
Well, you want me to say I'm a super genius and I figured it all out?
Or you guys had some strategy or,
we
approach to the business that was different?
First off, anybody with a checkbook can be a venture capitalist. Whatever people say to me,
why did you succeed?
Yeah, well, let's say I want to break into venture capital. Well, show me your portfolio. Like, you're going angel list and go fund some stuff and see how it works. We had a theory around how to construct a portfolio, and we had a theory about how to be a good co-investor. And those two things were unique at the time. I think our portfolio construction was probably wrong, but it was unique, and our how to be a good co-investor was right.
Can you elaborate on what those theories were?
Yeah. So, on the how to be a good co-investor, everybody in the venture capital business in 2006 wanted exactly the same thing. And they want it now too, which is they show up, I love your company. I'm a really active investor. I want to be on your board. I want to be on your comp committee and your audit committee. And I really want to own at a minimum 20%, but 25% is really our ownership target. And I need to own it now. Like right now. Otherwise, I'm not investing unless I get to 20% today. So 20% became a very expensive percentage to get because everybody wanted the exact same thing. And it became a death match between every VC. And it's awful for companies because the company's like, well, I'm going to be raising money forever because I'm build this company for the rest of my life. There's going to be like a series Q before I'm done. Why do I have to sell 20% to this person I just met on the street corner today? Like, that doesn't feel like a long-term partner. And they're insisting on, they tell me they're active, but what I'm hearing as an entrepreneur is this person needs to be in all of my committees and up in my business in order to do this deal. And I really like being an entrepreneur and not having a boss. And when I read the term sheet, it says, customary rights and privileges of preferred. What's that mean? And I start looking through I can't do anything without approval from this guy. And it's always a guy. That was the other part. It was like total all white. I'm a white man, but it was all white men.
Mm-hmm.
So we said, well, we're going to flip the script on that. First off, we have a co-founder is Dana Settle. I think we're one of two female co-founded venture capital firms that manage anywhere close to the amount of money we manage. It's nada in venture capital land. So that's one. And then the second thing was this whole arbitrariness around I need to own X and get to X and do this. And that doesn't sound to me like putting the entrepreneur first. That sounds like letting my fund size dictate my strategy. Mm-hmm. So we're not going to do that. And, as a result, we got into things. So we'd show up and the entrepreneur would say, have you read the term sheet you got from pick your whatever fund? And they'd say, yeah, I did. Have you ever thought about having a boss who tells you if you can hire people and approve a budget and sell your company and raise more money? And oh, I never thought about that. And our pitch is great for repeat entrepreneurs. They've showed it because they've been through the sausage maker before and come out the other side. I tried to sell my company and I got blocked by Sequoia and then it went to zero and I hate those guys. I mean, you'd hear those stories well, we won't let that happen to you. And so they're the ones who really helped us build not only our reputation, but our returns, because repeat entrepreneurs in the venture business are gold. You find them, repeat entrepreneur who's built a company before, who's got a team and a successful outcome, and they're not worried about making payroll because they can fund it themselves. I love that profile. We'll invest alongside you. You don't need me. You want me. I want somebody who can open doors and make intros and think about strategy and help with your network. I'm a partner. That's the best relationship in venture.
Okay. How do you think about the advantages of having a large AUM, assets under management for folks listening. It's one of the things people talk about a lot on the LP side. We're, always talking to LPs for our fund. And one of the things people are concerned about is that venture doesn't scale that well, meaning more money under management, typically lower returns. What's your view on that as a fund on the larger side of the equation, at least on the East Coast?
It's a really good question. I'm going to answer it from the other side of the tunnel and then work back to scaling, because ultimately we can deploy big dollars and generate big returns. The first challenge as a manager in 2021 is the venture business is global and it's becoming a platform business. And by that I mean we are seeing the same transition in venture that happened in the private equity industry in the 90s and the hedge fund industry in 15 years ago, whatever, the early 2000s. And it's happening in venture now. And a platform business means that I need, as a venture manager, to provide very significant services to my companies to distinguish myself from the next venture guy. Maybe even synergistic services.
There you go. The word worked
there
in.
You go. I worked it in. Buzzword bingo. That was A4. And second is I need to spend money on data. So we're spending millions on data and technology and product because we have to have, like, the entire internet world. Companies blow up all over the place all the time, and you basically need to build a Geiger counter, a Richter scale that listens everywhere and interprets signal. And we need to take those inputs and figure out through pattern recognition about where to invest to find the $50 billion companies.
Mm-hmm.
And that's really hard to do. And then the third is, like, the best investment professionals are expensive. I was the lowest paid person out of Columbia Business School. Like, I was ashamed to put my salary in those forms for a couple of years. Like, oh my, like Columbia is not going to be able to recruit people because my number is going to lower the mean or median. And, that was my job. But now I'm competing, and like the kids who have, I say kids, that's probably not nice, but the men and women who have 2 years of experience at, you name it, tier 1 consulting or banking firm that we're rushing to come into Greycroft, it's us or they're going to go work for Apollo. Like, okay, so I have no idea what Apollo pays, but it's a lot of money. And I've got to compete for talent. And, the talent game is fierce. So the only way to play the data game and the data science game and the talent game at the scale we want to play is to invest. Like, we have to have money from LPs, like fees, to invest. Otherwise, I'd be spending the $30 million a year it costs to run my infrastructure out of my own pocket. So that's the one side. Like, it's a necessity. The second thing is our companies. I'll tell you a story. I'm checking the time. I got time for stories. This is a great interview. You asked me like 3 questions, and I just like rattled stuff off. You can.
So I tried to have you on for longer.
Yeah.
I think you should plug your board meeting.
Sure. So I went to I was a like a spy at number 9 Downing Street. I probably shouldn't use the word spy, which is like the prime minister residence in England. And I got invited in as the token U.S. venture capitalist in a roundtable discussion of there's wonderful VCs in the UK, by the way, and we have a lot of LPs in the UK, and some of our LPs, including Cambridge Associates, et cetera, were all like in the room, and there were UK VCs in the room, and there was an open table discussion around how hard it was for UK VCs to raise money from UK LPs and why the market worked the way it did. And I will paraphrase, but the LP response, and they would like look at me. The LP response was, why would we invest in you if we could invest in tier 1 US VC firm that will give us US exposure, but also cherry pick the very best companies in the UK and Europe and Southeast Asia at the Series B. Because we may miss the first 50 or $100 million of value appreciation in the next Spotify. But we're going to capture 100 to 30 billion because our funds that we're investing in are, they're going to be cradle to grave funds in the US, and they're going to capture that. And I don't need this little bit of idiosyncratic UK exposure to capture that first 100 million. And I came back from that meeting and I said to my partner, Dana, who was in Los Angeles, like, we can't let that happen to us. We can't let the Valley firms go to the LPs and say, you don't need to invest in New York venture. We're gonna come in.
We're gonna
cherry pick all the best B's and C's. Can't let that happen. This was like life or death. And so
you shifted to build the growth platform at that point?
Oh yeah, that was 2014. Like I came back, called Dana. We were already working on it. I said, this is imperative. Because we can't let other people have our victory lap. Like, you can't be in the seed round and the Series A round and then miss a 30x B and a 20x C and a 10x D. Like, you can't do that.
Mm-hmm. Now, there's a lot of people, though, who are just in the early stage and they're putting up good numbers. And yes, there are the global platform funds that will do the growth play. It might be you guys in some cases, stepping in and carrying the next round forward and playing in the upside. Those firms can be well managed, deliver great yield to their LPs, but that model doesn't scale. And this is, I guess, the crux of it. It's if you want to run a lot of money, you have to get to that next stage, that bigger round where you're writing bigger checks. So the thing implicit in what you're saying is that you wanted to run a lot of money, where there's a lot of people who want to focus on just delivering a great multiple in a stage.
Yeah. There's room in the market for people who want to be a specialist in something. And there always will be. And I'd like to think that we broke our business into two. So we kept an early stage fund. That fund is small. It will likely stay small. We have a growth fund. That fund is bigger, and it's going to get bigger. And the reason we did that was you can be precious about a $1 or $2 million check in a small fund. It's really hard to be precious about a $1 or $2 million check in a $1 billion fund. In fact, like, no one cares.
Right.
And you see this, like the supermarket venture capital model of, I do everything out of one pooled vehicle and it's all collateralized. And like, to pick on an obvious example, like the NEA model, like someone, we're in Bright Health with NEA, and I love them. And they put in hundreds and hundreds of millions of dollars into that business, and it will return billions. And that's the deal that they're rewarded financially for doing.
Right.
And
all of their seed deals don't matter.
Yeah, don't matter. And the partners who are good at seed, they leave for whatever. Because like, I'm not doing the $500 billion buyout deal that is going to move this fund. And I didn't want that to happen. So we set up a structure where people can earn carry and work on what they want to work on. And the flip side of this is we do want to seed companies that eventually can return $100 million, right? So
that business still has to be attractive and functional for folks.
Yeah, and for us, it's like, well, what are the areas we should be playing in where the fish are big enough and the waters are deep enough? And there aren't very many global markets that have that characteristic. So we've been, over the past 5 years, a lot more focused on that.
So that brings me to an interesting question for you. I mean, when we talk to LPs and we hear people in the market, there's a lot of focus around the sector of a venture fund. But if I was to look at Greycroft on the outside, I'm sure you have your spiel of sectors you tout to LPs because they like to hear that, right? But they're, at the end of the day, you look pretty generalist for internet. And, you know, when I hear the demand from LPs to have a sector focus, I'm confused by it. It's obviously a trend. It's a way for people to differentiate themselves. What is your view on sector-focused funds? Is that important? Is it good or bad?
I'd say we at Greycroft are a sector-focused fund, but we're not the same sector every time. And this is really important. So
you change by fund.
Oh yeah. Right. I mean, we have 5-year roadmaps, cycle in and out. Sometimes we kill them early because they're played out. At the moment, everything we do fits into, these aren't neat buckets. Like some things have overlap, right? But we have a fintech portfolio. It's both consumer and enterprise. We have a consumer internet portfolio. We have an enterprise software portfolio, and we have a digital health portfolio.
Okay, and
that's essentially everything.
And a company walks through the door that doesn't fit in any of those. You guys don't do it? Is the next unicorn? The next 50, mega unicorn?
Well, the short answer to that is there's also a separate sidecar, like experimental thing that is a small percentage of capital. And almost everything, if you really wanted to, we could fit into one of those buckets.
Right. So you've defined your sectors, just to call it for a second, broadly enough where you can shoehorn the entire internet into those sectors. So you can tell folks there's a sector focus, but you do the internet.
But like, for instance, we did some consumer products investing years ago. We've cycled out of almost all consumer, unless it's a connected device. Like there's an internet story, but like hair care, skin care, CPG products, that we've cycled away from.
And that's a macro trend in the market. Most people have cycled away from those.
Yeah, we invested in media. We've cycled away from media. We invested within enterprise software. There's things that we don't do. We did a lot of MarTech, ton of it, but 9 more. So you can't be the same person tomorrow that you were yesterday. And part of the problem with a sector-focused fund is good for now, but it becomes a straitjacket. And you want to avoid wearing a straitjacket to work every day. So my advice to people, if you're trying to raise a fund, you need to be good at something and have a track record and credibility, but that something needs to be broad enough that it can extend into the next new thing and the next. Like Roger Ehrenberg's a great example. He raised his first fund on big data. Like, big data is coming. Big data is not a sector. Big data is like mobile. It's an attribute.
Right.
And the ability to tell a story that said, well, here you've got this underlying change in the way data is created, structured, managed, indexed, search, whatever. And then I can apply it to TransferWise. Right. I don't know how that jump was made, but it was made.
It sounds great, but it catches the whole internet.
Sure.
To a certain extent, what's not dealing with massive amounts of data in the world we're in.
Yeah. And like there's all sorts of secular trends and things changing that people are focused on right now.
Let me pull you in a different direction here for a second. You've been doing this for a long time.
You've started 2 questions with you be doing this for a long time.
I know, but I want to pull the wisdom out of you. I want to pull the wisdom.
I'm grandfather time over here at age 41.
Well, age 41 in startup land is pretty old school. I got referenced as OG New York in an email a week ago, and I'm like, wow, I guess 40s is that.
I'm going to start sending that to you, OG. Okay, go ahead.
What makes someone a good founder? I want to ask it really broad because I think there are so many people out there trying to jump into this, whether they're micro VCs or they're angels, and there's some pattern matching that people who have done this for a long time see. is there a framework or a way to articulate what it is you're looking for in a person? The company dynamics are easier for people to get their hand around. It's math, it's market analysis, it's their gut. There's a lot of things that people are using that may or may not work for them. But the founder bit, it's kind of hard to grab until you've done it for years and years and years.
So there is no good answer to that question, because a good founder for one business would be a bad founder for a different business. So I would punt. But if you said to me, what do I look for in a founder?
Sure.
And just make it a different answer. I think pattern recognition in venture is just it's understated in its importance, because it is everything in early stage venture. And the patterns start to line up once you've seen enough companies. And one of the founder patterns, I mentioned before, I do a lot of repeat entrepreneurs.
Mm-hmm.
In addition to that, the best pattern is, and you can record this and put it on YouTube, and it is the secret to making money in venture capital. So now the secret is out. But the best pattern is a repeat entrepreneur who has successfully built, scaled, and exited a company for enough money that they're still hungry, but not too much money that they don't care anymore, and has then left, recruited their former team. So one of the questions is, so you started something before, who worked with you before? And gone back into the same or directly adjacent market to the one they were in previously. And the person has to be the CEO or co-founder, leader in the business, not like the head of marketing or whatever. I don't want to disparage marketing people, but you get it. And then they have to recruit people who've worked with them before. And they have to be in the same industry. When I see that pattern, we just auto fund, because
like the Jet story.
We've never lost money. And, well, yeah, and we've made a fortune on that pattern. And we only used to see it once a year. Now we see it every month, and maybe more frequently. And when you do, it's just a question of how much you're willing to pay and whether they like us. And
Right.
Everybody knows this in the venture industry. And the second thing I'd say is the worst pattern in the venture capital business is almost exactly like the first pattern, but with two exceptions. One is they didn't bring anybody with them. And you start to dig. You're like, well, this guy was an asshole and no one liked him. And the company was successful in spite of him. And he was pushed out of the boardroom, and okay, well, got it. So he was just not great. And the second part of this is I was really, really good in enterprise software, and now I'm going to build a consumer company. And that doesn't work, because the talents required to build an enterprise business are very different from the talents required to build a consumer business, which is why I couldn't give you a generic answer.
That's great. Thank you. Let me ask the same question, but for VC. Look, you have a large VC team. Most people have probably not hired and managed as many VCs as you are at this point, even at the big firms. What makes someone a good VC?
So I think the attributes of some, and I don't know that I'm good. I some days I wake up and I think that, Jesus, we just totally effed up and we missed 20 great things. And, you lay awake at night thinking about the 10 deals that we gave Trade Desk to another firm at $3 million. And every time I see,
we passed on public and gave it to you.
No, whatever. But that's another story for another day. But whenever I see Jeff Green, he's like,
you feel terrible.
Remember when you didn't invest? And or ACV auctions, just the number of companies that come through, and you're like, well, whiffed on those. So we don't have the anti-portfolio on our website. We should put one up like Bessemer, although it's a little bit played out at this point. So I guess the things that I would think about, one is you just have to be intellectually curious. It is not enough to like startups. You've got to really be a student of why stuff works the way it works. And most people aren't built that way. Like most people don't wake up in the morning and drink a cup of coffee and be like, oh, this doesn't taste quite right. Why? And you start like Googling things and you start to figure out, oh, well, gee, this thing was ground like in a factory 7 months ago. And then they aired it out for like, you have to want to know why things work the way they work and why the world works the way it works. And most people just aren't curious.
How do
I
you
don't know
interview
why,
for that?
but they're not curious.
Because I know this is a characteristic about you. Every time we've talked, you've read some other randomly obscure part about trading markets and, things that normal humans don't know about, care about, or have no interest in. But you're knee deep in it. How do you hunt or find that in your process?
You ask people questions about like what they find interesting, and you just keep asking why. It's not annoying. It's like, why? But it's like, oh, why do you think that? And then they give you an answer like, oh, that's interesting. If you thought about this, and then he's like, oh, why not? And you just keep going. And eventually you get to like some fundamental thing about like, well, I was just really curious. So that's one question. The second question because people we interview have ridiculously good resumes. Like, I don't know, like never failed at anything in their whole life. And it's all on a piece of paper and it's all perfect. And I always ask the question, what are you most proud of that's not on your resume? And there are some really good answers to that question, which I won't share with you, but because then every interview I ever do from now on, people are like, oh, of course. But you can think about that. And the answers you get on that question can be really telling about how people work and how they think about the world. And so there's that part. I think it goes with the territory. Like you have to be, we before we hire people, we make them do a case study and then we make them defend their case study.
That's fantastic.
So we say, here's a company, write a 2-page memo, not more than 2 pages. I don't want 40 pages. I want 2 pages about, why we should invest or not with a recommendation. You can put some charts and graphs in like an add-on. And then they come in and then they get like the gauntlet from the partners. So you said this, why do you think that's true? And they have to be able, it's hard to do this, by the way, when you're 24, 25. Super intimidating.
I'm nervous hearing about it.
Yeah, you sit across from me and you're like, oh God, it's this guy just quizzing me about some company I read a thing on. And I always try to figure out like who goes like the extra step. And the extra step would be, I didn't know a lot about this company, but I made 3 phone calls to people to see if I could figure something out. And here's what I learned. And, or an insight that I remember this so clear. I should have hired this person. We gave a nice guy a case study, and he gave us back this whole logistics analysis about why the company wouldn't work. And it had to do with the weight. This company was like a micro cafe that was robotic, and it had to do with the weight of the water. And he like calculated like how many people do you think in New York could carry 96 pounds of water up 4 flights of stairs? Like, oh. And he's like, yeah, I called this guy from Anheuser-Busch. He said, yeah, how easy do you think it is to hire a mixed gender workforce to carry kegs? Like, oh. And you're like, okay, well, now I understand.
You're almost out of time here. I know you got to run. You're a very busy guy. Feels like every time I'm trying to catch you,
I hate the word busy. I hate the word busy.
But you are.
I
got a lot going on.
People make their own busyness.
Right. But you're working hard still and you're building.
Yeah.
And you're ambitious. What's success for you at this point? Most people look at where you are and say, he made it. right? He built a great firm, he's accomplished what he wanted to do in his life. Where are you going? What's success for you?
So I have a coach, which may surprise you,
too.
Hired this coach because I was suffering from this problem. Like, what do you do next when you've kind of like growing up as a kid in Ohio, where I grew up? I'm not really sure that I had goals outside of like the next thing I was looking down the road at, let alone where I am now and where to go next. And it's a very hard question to answer because it's a personal question. I mean, I know work-wise where I want to take Greycroft with my partner Dana, and we're in lockstep on it. That there's also personal gratification and contentment that comes from other things outside of work too that I get to spend more time on. And I think there are the two big things that I spend time thinking about. One is I want to create more than we like. Venture capitalists also destroy industries, right? We come in and we fund a company, and that company that's growing 100% a year and is ripping, as my colleagues would say, the economy is only growing 2%. So it's taken something from somewhere. That spend is coming. And I feel like, I think in the back of my mind, like, I want to create more than we destroy over the course of this career. And how do I, as like a North Star, do that? How do I build a new industry instead of something that just sucks in like a black hole money from another industry? It's hard to do. And I think the second thing is, business wise, we were 75 million of assets in 2010. And we're 2 billion and some change 11 years later. I want to grow faster in the future. Like I want to get to an interesting point. I don't have one.
It's not like 50 billion or 10 billion. Is there some number in your head that you're chasing?
No.
Oh, I think you're not sharing.
No.
Okay. And
if I told you and the number was like 10 trillion, you'd be like, Ian, that's not possible.
But I'd respect it.
But yeah. Like, SoftBank Vision Fund, $1 trillion. No, I'm kidding. I don't have that vision.
Hey, this was fantastic. You delivered. Thank you. Good insights.
Thank you.
I'm sure everyone listening appreciated it. Thank you so much for your time. Special thanks to Ian for sharing his unfiltered thoughts today. I thought it was super insightful, and hopefully it was helpful for everyone in learning about venture capital. If you like what you heard, please hook us up with a like or a 5-star review, and feel free to share with a friend. You can find me on Twitter @MPD. And to hear more of my conversations with innovators, subscribe on YouTube, Facebook, or any major podcast platform. Just search for Innovation with Mark Peter Davis.